Be honest, are you guilty of this sometimes? Mindlessly applying to any and every IPO that's available? Even when I started out in the stock markets, I honestly thought IPOs were designed to help us retail investors make money. A sort of godsend, if we got allotment, that is. I mean, what can go wrong with a newly listed company? I'm sure they've got their stuff in order before listing, right? But that was me just being naive. So today, I'm not going to tell you what you should look for before applying for an IPO. There's plenty of material out there on the internet for that. But I'd rather take you through my learnings about this space and the mindset of IPO promoters. A little out of the box approach. I pray you already know the basics of what to look for, like comparing the company with already listed counterparts, their basic financial ratios such as PE ratio, debt equity ratios, return ratios, their business model, their grey market premium is also very important, etc. etc. And of course, go through recommendations of a few brokerage houses. Prabhudas Lilladher seems to be my favorite financial services company, and I hold their recommendation in high esteem. Also pay close attention to how their stocks react when lock-in period for early investors end. Shares of Nykaa, Policybazaar and Paytm have fallen quite a bit after that. Usually, if the company's financials are good and they're making a steady profit, expiry of lock-in period won't affect the share price much. Okay, so starting off, I'm going to state the obvious here, but it needs to be said. Few years ago, the main purpose of IPOs was for the company to raise money, to fund their operations, to pay off debt, to expand their businesses or whatever else. These days, with so many of these tech IPOs, the main purpose seems to be to give their early investors a profitable exit. So it's less about continuity of the business and more about profits. In fact, these days when venture capital firms invest in startups, they discuss exit strategies before they commit even a single rupee. Gone are the old school Warren Buffett-like thinkers who believe that investing in a business is like raising a child. You have to stick through thick and thin and enjoy the process. These days, it's all about quick profits. But I guess you can't blame them either. I mean, look at the crazy amounts of money at stake. InfoEdge invested 4.7 crores in Zomato in 2010. Zomato went public in 2021. And do you know, InfoEdge's 4.7 crore investment was worth somewhere near 5,000 crores. That's a 1050x return in 11 years. So of course they sold some of their shares at that price. Zomato's share price has now dropped below its IPO price, like all new age tech companies. But that's another story. Alibaba founder Jack Ma's Ant Group was the second biggest investor in Zomato, and goes without saying, even they made a killing. So in today's times, when early stage investors hold maximum stake in tech startups, obviously they have the maximum say also in those startups. It's almost as if they hold those startup promoters hostage, telling them what to do and how to do it. Don't raise money from there. Go in for an IPO now. Just to give you an example. What happens in such situations is that most tech companies come out with IPOs after assessing market conditions, when they know it's bound to be a success, so their investors can get a profitable exit. A perfect example of this is Oyo Rooms. Oyo was supposed to come out with its IPO in 2021, but kept delaying it. And now finally, after waiting for the dust to settle, it plans to come out with its IPO in Jan 2023. Now, I have no proof of this, but I'm going to go out on a limb and say that Ritesh Agarwal didn't have much to say in this. Oyo's biggest backer, SoftBank Group of Japan, is probably calling the shots. On a side note, I'd like to say the last 1 year has been horrible for Oyo and consequently for SoftBank as well. Oyo had a valuation of $10 billion in 2019, which recently got reduced to $2.7 billion now. So point being, companies wait for an up move in the market so valuations can improve before they come out with IPO. So I wouldn't blame you for applying for all tech IPOs for listing gains. Again, if you're lucky enough to get allotment. Turns out that meme at the beginning of the video does apply in this case. Also, in the technology sector, growth happens very fast. So gone are the days when companies would establish and grow their business over decades and finally, after years of showing consistent profits, come up with an IPO. Nowadays, with these new age companies, it's as if they're pumped up on steroids. They sell a dream, a distant dream of a profitable future. Get some big time venture capital funds to invest in them at high valuations, whether those VCs believe in their business model or no. Then they grow their revenue, not profit, by leaps and bounds for a few years, and then dump that vision of a dream onto the stock markets in the form of an IPO at even higher valuations. So the ultimate winner in this game is the VC fund, and the poor unsuspecting retail investor who bought shares after the company went public. Well, ask these investors. Also, SEBI has now allowed loss-making companies to go in for IPOs as well, as long as these loss-making companies allocate more of their shares to institutional buyers such as mutual funds, banks, insurance companies, etc., and give less to retail investors. SEBI's reasoning is, if these institutional investors are willing to pick up at least 75% of shares offered in the IPO, it's probably safe to allow 10% to retail investors. No wonder then some famous loss-making names like Burger King, Barbecue Nation, Macrotech developers, you may know them as Lodha, and even Paytm and Zomato types were able to tap the markets. Okay, so let's assume you're bullish on a company that's going to go for an IPO, and you want more exposure to that company than the usual allotment of one lot, which turns out to be somewhere near 15,000 rupees. What are you going to do? One option is you can even buy shares of companies not yet listed on the stock exchange. This may seem tricky because there's not as much information out there about unlisted companies, and they're not as regulated as their listed counterparts. Expert opinions and analysts tracking them are also very few. And not all brokers deal in unlisted shares, so you'll have to look for one. And there's a lock-in period of 6 months in which you can't sell those shares after their IPO. Also, you can't buy unlisted shares of all companies. And you can't sell those shares as easily as you do for listed shares because there's not enough liquidity. And sometimes a company that's expected to go for IPO delays its plans, so you may get stuck. Personally, I bought unlisted shares of HDB Financial, which is a subsidiary of HDFC Bank, and it was expected to go for IPO more than 2 years ago, but I'm still waiting. But all these points aside, if you genuinely believe that a company can become a multi-bagger after listing, then it's worth buying their unlisted shares and wait for them to list, because this way you can buy as much quantity as you like. Some famous companies yet to list include Ola, Byju's, and even Oyo. These are just examples and not recommendations. Another way, if you want more allotment, is something called IPO Financing, where HNIs borrow money from finance companies for roughly 7 to 9 days on average and can put in bids up to 1 crore of rupees in a single IPO. Of course, they pay upfront margin and interest on this borrowed amount, but the sheer size of their allotment allows them to profit big time if the IPO lists at a premium. Mind you, it could go the other way as well. The secret is there are different categories through which you can apply for IPOs, and HNIs or high net worth individuals apply from the non-institutional category, unlike retail investors. This is how IPO financing works. Let's say an HNI borrows 1 crore rupees to invest in an IPO. If the HNI category is oversubscribed by 5 times, then he or she will get proportional allotment, which works out to be 20 lakhs in this case, which is still a lot. And finally, I want to bring your attention to our new SEBI chairperson who was appointed in Feb of this year. Ms. Madhabi Puri Butch is an absolute trailblazer. She is the first woman to hold the post and is very proactive when it comes to investor protection and other matters related to the capital markets. She even summoned Mr. Gautam Adani twice to meet her. God knows what was discussed in that meeting, but one can speculate. Because Mr. Adani just recently bought 3 listed companies in a hurry, and there are claims he's growing too fast and killing competition along the way. Be that as it may, SEBI is coming down hard on IPO bound companies, in the sense that it's framing new rules to protect investors so they don't get their fingers burned. All in all, as retail investors, I think we need protection in this brave new world. Protection from big institutional investors who want to make money at our cost, and sometimes protection from our own greed. I'm in support of more regulation, whether that be for cryptocurrencies or for risky IPO bound companies, as long as it doesn't come at the cost of progress. Thank you.